Welcome back to the second instructional video for the profit generator. In this page, we're going to play around with the hourly rate, adjust our cost of goods sold by a certain percentage, adjust for inflation, adjust our accounts payable by a percentage, and we're also going to talk about what I mentioned in the first instructional video about adjusting for a $5,000 vacation or buying a $25,000 truck. So here is the first page of the profit generator where we entered all the information from our P&L statements. Click on page 2. And now we are on the second page, and the first thing we see is our present and future income columns at the bottom. The numbers from the present vertical column are being pulled from the first page of the profit generator. The numbers down here will calculate based on your entries from up here at the top. So let's just play around with the first box at the top left. If you increased your hourly rate, how much will that increase your profit? Let's enter an amount right now down to the penny. We'll start off with 10 cents and see what that does. As you can see, the extra profit we made per month by raising our hourly rate just 10 cents was $32 per month or $383 per year. I believe you just got your money back from purchasing this app. Let's drop down to the next box on the left and let's increase our cost of goods sold to our customers. Let's put in 1%. Over here, we see that we just bumped up our profit $740 a year just by increasing our cost of goods sold by 1%. I believe you just got your money back again by purchasing this app. Now, let's adjust for inflation, say by 1%. Everybody knows what inflation is, the cost of living increase. Inflation runs between 1 and 4% depending on the economy. The inflation entry box and the box below it are somewhat identical in what they do. The percentage for the yearly inflation is more of a general roundabout number. Where it says to enter a percent that your accounts payable will increase, this is where you would enter your own personal calculations based on what increases you have seen within your own P&L statements. So, if you have a workers' compensation claim that raised your rates, the percentage in this box may be higher than the entry you would have put in for yearly inflation. One thing you don't want to have is a percentage number for yearly inflation and a percentage number for your accounts payable increase. That is why there is the word "or" between the two sentences. In a sense, you're putting in an amount for inflation and for your accounts payable. Long story short, one of these boxes needs to be a 0. Quick tip. One simple way to find out if your accounts payable have increased or decreased from last year is to look at your prior year's profit loss statement and compare the expenses from last year to this year and figure out the percentage difference between the two. You'll have a better estimation that way. We'll keep our hourly rate at 10 cents and cost of goods at 1%. Let's go ahead and change the inflation rate to 0 and let's enter 7% for an increase that our accounts payable charged us. This could be where they raise your insurance or your phone bill or maybe the price of gas went up, whatever it is. Now, as you can see in the total operating expenses row, the 7% increase with our accounts payable, we are now taking an $18,000 hit per year, or the box above that says we need to come up with an extra $1,400 every month just to pay for the 7% increase. The solution to this problem is in the box right here. In order to bring those numbers down, we need to raise our hourly rate by $4.51 to $4.61. So, if you figured up that your account payables difference from last year was 7%, by the looks of the calculations, you would have to raise your hourly rate $4.61 to keep up with your accounts payable rising costs while maintaining your present income. As we can see in the monthly net income row, we are breaking even keeping up with the 7% increase with accounts payable and raising our hourly rate by $4.61. You don't adjust this number, it comes out of your pocket. Your accounts payables, probably a national company, raise their rates on you in order to keep investors happy. You know what you have to do in order to stay in business. So our next option is to either raise our hourly rate or increase our cost of goods sold to customers in order to maintain our yearly profit. So let's raise our percentage of the cost of goods sold to 5% and we'll see what number we come up with. As we can see, we made an extra $3,000 in profit. Let's bump it up to 15% and see what we get. Now we can see we made an extra $12,000 profit by raising our hourly rate and our cost of goods sold. Whatever you increased your hourly rate and cost of goods by, it increased your total sales for this company by $30,000, and it reflects here in your total sales right here. So let's go back to our accounts payable percentage number. Let's put in a number of 3%. Now you can see our profit went up $22,000 by raising our rates by $4.61. So maybe raising your hourly rate $4.61 is a little steep per year. By keeping your 15% increase for cost of goods sold and leaving your accounts payable increase of 3%, you could lower your hourly rate or keep your hourly rate where it's at and adjust your cost of goods sold percentages to come up with an hourly rate and cost of goods percentage increase you're comfortable with. So let's change $4.61 to a 0, basically saying we're not going to raise our hourly rate. You can see that without raising your hourly rate, we're still making $5,000 more profit per year, and we've only increased our cost of goods sold by 15%, and we can pay for the 3% increase our accounts payable upcharged us for. Let's go back and put the accounts payable to 7% without raising our hourly rate and see how much we would increase our percentage of cost of goods sold in order to pay for our income loss. Let's put in 20%. As you can see, we raised our cost of goods sold percentage to 20%. We didn't raise our hourly rate, and we were able to pay the 7% increase on our accounts payable. Total sales went up, cost of goods went up, you maintained the same yearly income as last year, your hourly rate didn't change, your average billed invoice went up $10, and your average materials sold per invoice went up, and you were able to pay for your accounts payable increases. So now, let's take a look at this $5,000 vacation or $25,000 truck calculation I mentioned in the previous video. We're going to enter a dollar amount for vacations, bonuses, retirement, or new vehicles right here in this box. Also, keep in mind, these calculations are based on the amount of employees you entered on the first page of the profit generator. So a company with 2 employees may have to raise their hourly rate by $5, where a company with 10 may only have to raise their rates $1.50. So let's put in $25,000 and have this truck paid off in 1 year. 2 boxes up, we see that we need to increase our hourly rate by $6.55. We'll go ahead and put this in this box and see what happens. The $25,000 truck will be paid off in 1 year just by increasing your hourly rate by $6.55 and keeping your total cost of goods sold percentage at 20%. So maybe raising your rate $6.55 is a little steep. Let's adjust the numbers to make this truck purchase work for your company. Let's adjust the payoff for this truck to 5 years and see what numbers we can come up with that may not be so aggressive. Let's adjust $25,000 to a 5-year loan to $5,000. Here we see we need to drop our hourly rate $5.21 down to $1.34. Here in the net income row, you may be thinking that I'm breaking even buying this truck. Keep an eye on the net income row right here. Let's go up and remove the $5,000 and see what happens. So, in a sense, by raising your hourly rate $1.34 and raising your cost of goods sold by 20%, you were able to afford this truck. You raised your hourly rate $1.34 and bumped up your cost of goods 20%. $1.34, that's chump change. Now we can look at the bottom box and look at the comparisons between present and future income. You can see the difference in net income, the cost of goods sold per employee, your break-even hourly rate, how much the average billed invoice per customer went up or down, the average material sold per invoice, and the average profit per invoice. A quick reminder about the reset button up here. Clicking this button will reset all 3 pages of the profit generator, not just this one page. You click this button, you start over at page 1. Let me do something really cool here first. I'm going to clear all these to a 0 value. I'm going to put in a 0.5% here in our cost of goods sold. A 0.5%, which is 0.5. Look at your yearly net income now. That would be a 50-cent increase on a $100 item that you sell. You can now more than afford to purchase the profit generator. Gold Edition. And you haven't even seen the third page yet. You can use a profit generator every single month. Like I said in the first video, just take the oldest month off the profit and loss statement from last year and add in your new monthly profit and loss statement for this month. Now you have 12 months P&L statements. If your sales drop 1 month, you'll know exactly what you need to do next month in order to adjust right down to the penny. If you found the information in this video to be useful, you can click here to subscribe and come back and watch other videos. You can make a comment here, or give this video a thumbs up, or leave a positive comment on our website at www.thelpsolution.com. Thanks for watching.